The mortgage company keeps its claim on your property even after a fire destroys your home. Most people don't realize this harsh truth until disaster strikes. When your house burns down, your financial obligation doesn't disappear with it. You're legally required to continue mortgage payments despite not having a habitable home. The lender's interest remains tied to the property regardless of its condition. Here's what you need to know. First, contact your mortgage servicer immediately. Many lenders offer forbearance options. Temporary payment pauses typically lasting 3 to 6 months. This gives you breathing room while working through insurance claims. Your homeowner's insurance is your lifeline. The policy should cover both rebuilding costs and mortgage payments during reconstruction. The insurance check will likely be made out to both you and your mortgage company, requiring both signatures before funds release. The mortgage company will typically hold these funds in an escrow account, releasing money in installments as rebuilding progresses. This protects their investment and ensures the property is restored. If you're underinsured or face a claim denial, you're in a difficult position. Some options include negotiating a loan modification, selling the land, or in worst cases, considering strategic default. Document everything during this process. Keep detailed records of all communications with your insurer and mortgage company. The key to surviving this nightmare scenario is preparation. Review your homeowner's insurance annually, ensure you have adequate coverage for full replacement, and consider adding loss of use coverage that pays for temporary housing while rebuilding. Don't wait for disaster to understand your mortgage obligations when the unthinkable happens.